Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is John Herzog. Hi, John.
Hi.
John is a bank officer with Valley Community Bank in San Jose. He received his Bachelor's of Science degree from San Jose State University, where I happen to get my bachelor's degree. He got his in May of 1975. His banking career started at Bank of the West in 1980, and he worked there for 13 years. And then he left as an assistant vice president and branch manager at the Cupertino office. I got an auto loan from him there. From 1993 to 2006, John worked at Comerica Bank in the small business group. Left as a first vice president, and then from 2006 to the present, he's worked as a first vice president for a Valley Community Bank focused on small business relationships. So thanks for joining me again.
I'm very happy to be here.
Okay, John. So with that, we'll go ahead and get into our questions. Now, folks, today what we're going to be talking about today is small business financing. So a lot of people that are wondering, they're trying to start small businesses these days, or they may having issues, they need to get financing for the small business. And so we're going to get the picture from the community bank point of view. So what is the state of the banking industry today related to small business banking?
Well, I think really the industry, for the most part, it has been business as usual. Right now, currently in the United States, there are approximately 8,000 banks. And the vast majority of those banks have been really applying traditional underwriting standards throughout the years, in the good times and now in these challenging times. However, there have been some banks that had some looser guidelines during the good times, and that is affecting a lot of small business people out there right now.
Okay. Now, when we talk about underwriting, just for people that know, because it's a little bit of a jargon word, and that is, what does it take to qualify for a loan, basically, with the bank? So the underwriting process is where the bank is evaluating the person and whether they qualify for financing.
Well, right now, I think there are two things going on. A lot of small business owners are having a challenge to generate profitability sufficient enough to justify being approved for loans. So that's one of the things that's actually happening right now. Mm-hmm. Another factor is some of the banks that did have loose underwriting standards have now, the pendulum has swung 180 degrees in the other direction. So instead of providing the traditional underwriting standards, which is looking for cash flow, looking for collateral to support the loan, looking for stable credit history, they're asking for more conservative traditional requirements. Mm-hmm. And so that has put a strain on people's ability to get qualified if they're banking with certain institutions. Yeah.
So I've always been able to get the loan with the bank before. What's the deal? Why has it changed? So anyway.
Well, really there are different things that banks do to evaluate the credit worthiness of a small business owner. Mm-hmm. And in my opinion, the key factor that small business owners should really focus on is the ability to generate timely and accurate financial statements. Mm-hmm. And as a good rule of thumb, when you're starting out and maybe your revenues are under $1 million, it's okay to maybe generate a financial statement on a quarterly basis, meaning a balance sheet and an income and expense statement. But then as the size of someone's business is growing, they should focus on really striving to have generating financial statements monthly. Mm-hmm. And whether a business owner is getting those financial statements to get a loan or not, it's really good business practice to be able to review your financial position monthly if you're a small business owner. Mm-hmm. So you don't do it just for the banker or for the loan request. You really do it for the ongoing health of your business, to really look at the trends of the business and monitor those trends and make sure that you're making adjustments quickly enough based on the changes that you're seeing. So that's really the key. And for most small business owners, having a experienced CPA who can help you generate those monthly financial statements is key to their long-term success. And what a lot of small business owners don't realize is that when they do apply to a bank for a loan, a business loan, the bank will look at the financial position of their balance sheet and put as much importance on that as the financial condition of their income and expense statement. So as a good rule of thumb, knowing what level of leverage to maintain on your balance sheet and the level of liquidity is valuable. If, for example, let's say you're a small business owner and you're looking at your monthly balance sheet and it says it reports that you have about $600,000 in total liabilities on your balance sheet. Well then, a good rule of thumb is to always strive to make sure that those liabilities don't exceed your net worth on your balance sheet by more than 3 times. So in that example, striving to have at least not letting your net worth go under $200,000 in that example. And during good times, when profitability is stronger, having a goal to get that level of net worth up to 2 times is even more recommended, because then when we are in challenging times, and if you have a loss, you have the ability to still function properly. So that's a good key factor to consider. When banks are looking at a balance sheet, they'll also look to make sure that the owner is keeping their current assets, which is their cash, their receivables, and their inventory. Those are their primary current assets, at least greater than their current liabilities. And ideally, as a business owner, you would want your current assets to be at least 1.25 times your current liabilities as a minimum, and strive to have it over 1.5 times when times are better. And this ensures that you have enough cash on hand if you're a small business owner to meet your normal bills each month, including your payables and your payroll, and maybe unexpected expenses that can come up from time to time. Now, once you're able to generate monthly financial statements or quarterly financial statements, depending on the size of your business, and you're doing a good job keeping enough liquidity in your balance sheet and enough sufficient amount of leverage, not over leveraging your balance sheet, banks will also look at the condition of your primary assets. So a good rule of thumb is to always stay focused on the collection of your receivables, and be real careful on who you're giving trade credit to, and having a firm policy in how you will do that and how you will follow up if your customer is not paying you in a timely manner. A good rule of thumb is to try to keep the level of your total receivables not more than 15% of your total receivables, not more than 90 days past due. Now, that's very challenging to do right now in this environment.
Right.
And most small business owners don't have that, but that's the goal to strive for, not to let your 90-day past dues get more than 15% of your total ARs, because that can then affect your profitability and the overall ability to get financing down the road.